Infosys yesterday lost its bottom. The stock collapsed more than 10%, one of the steepest fall we've seen in Infosys in a long time. Last time it fell like this was when Mr. Sikka exited. But what's ironical here is that this time the allegations against Infosys are something which is making markets worried, because you don't know, and the fear of unknown for Infosys I think has kicked in. So till Friday, Infosys was handsomely outperforming the market and handsomely outperforming Infosys. After yesterday's gut-wrenching fall, when more than 50% of the share was marked for delivery and short positions have got created, Infosys pretty much has evened out this year in terms of where it stands. Sameer, will you buy Infosys?
Morning, Nikunj. I think what has happened in the stock is quite unexpected, because what we saw 2 years back and what steps were taken so as to restore confidence, these kind of allegations coming in a company that has been the stellar corporate governance example, so to say, for corporate India, I think that is perhaps numbed investors yesterday. So I think first thing is, one would need to know how proven or substantiated are these allegations in the report. And then there is also an overhang of a class action suit because the stock is ADR listed. So I think that is what is making the people jittery, and investors are more or less wondering that today, after Nandan having stepped back and the corporate governance being taken up and set, all the nerves were soothed. Today, what has come out is actually quite damaging. And even though the valuations are not that expensive anymore after the fall yesterday, I think there are a lot of significant events for which investors would look for answers before wanting to take a shot at the business. Although the growth numbers were good, people were quite happy with the TCV wins in this quarter. There have been some concerns also in terms of the subcon costs, etc. But I think on balance, there still needs to be some amount of clarity to emerge for people to take a price call more than anything, because now it's not a question of just a business at a price, because in case there was some merit that was found post the inquiry into the whistleblower allegation, then I think it could mean very different outcomes.
What is yesterday's price damage telling you? Serious amount of market cap erosion, a 16% fall. Overnight again, the ADR has fallen 3%. What next?
So I think the stock should be in for more correction. And I think one of the data which was very interesting yesterday was an addition of 18,000 contracts for Infosys on short side. So if you multiply it with the lot size, it's almost 93 lakhs, 94 lakhs of fresh additions of short positions for Infosys, which is huge. And for a large cap stock like a Nifty 50 stock, and that too for Infosys, which holds one of the higher top 10 percentages on the Nifty, I think this is a substantial increase in open interest, and that itself indicates that the stock should be in for more correction. The stock closed at the lowest point of the day. There was a mild recovery in between, but that was sold into. So the weakness intraday as well, and the weakness on the carry forward basis on the delivery data and the options data indicates that the stock should be in for more correction.
To banking earnings as well, although Kotak came during market hours, Axis was at the fag end, or actually just after market hours. It swung to losses, but don't go by that loss figure because there is a one-time tax charge as well, and which is why you have that loss quantum of 112 odd crore rupees. So don't be fooled by that, because if you were to look at just the PPP figures, the numbers are at par with street estimates. In fact, on all counts, Sameer, it seems like Axis has delivered what the street wanted it to.
Yeah, Aisha, I think Axis numbers, they are maintaining the trajectory of what we've seen over the last 3 quarters, that yes, there has been some sort of a arrest on the asset quality deterioration, and the fact that now you are seeing that the management has sort of taken a positive guidance. But the idea is that today, when you're looking at the loan growth, I think loan growth at 14-15%, with the fact that you see some spots of commercial vehicle portfolios showing some stress, and at the same time slippages also not coming down as much as expected, I think those are red flags. But having said that, the valuations have now corrected to about 2.5 times book. So that's not too bad a price for people to look at, assuming that this trend further accelerates and the normalized earnings are now much more closer than what you were once the entire corporate credit cycle hit the bank.
Okay, what about Kotak though? Would you be a little worried about the asset quality, the fact that it's come off and it's worsened?
Aisha, I think Kotak one looks for as a torchbearer as to what is actually happening on the borrowing trends, etc. So I think there also the loan growth falling to 14% against same stress points of CVs. I think those are things that there is some problem that is happening in the sort of nuts and bolts economy, so to say. Because CV portfolios not picking up, which means there is less freight, which means people are not getting enough volumes, which means the payment cycles sooner or later for most of the NBFCs who have probably lent out loans to these will also start seeing some sort of 30 days, 60 days kind of a deterioration in the asset mix. I think those are factors that probably will concern investors more going forward.
Asian Paints as well handed a colourful report card despite the slowdown blues. They've registered their 7th consecutive quarter of a double-digit decorative volume growth. The profit as well has managed to beat the street estimate. Margins and sales, though, you could say were a miss. Pankaj, how's the brokerage fraternity absorbing the numbers?
So, when we look at the brokerage numbers, of course, the point that you were making about the volume number is something which everybody is talking about and everybody is praising. That volume growth seems to be on the decent side. However, it's broadly in line with what the street was anticipating. So, yes, it's a colorful sort of a volume growth, but nevertheless, it was largely expected by the street. However, the street is not that happy when you talk about the margins, when you talk about the overall sales numbers, and that's why no major upgrades or downgrades have come in as far as the street views goes. Mostly people have maintained their estimates, whether you talk about this year's earnings estimate or you talk about the volume number that has happened. 11 o'clock today, of course, is the call. So guidance over there, what they are expecting for Q3 or any trend sort of analysis, if the management would share, would be something which will be interesting to see. Morgan Stanley, for one, has written an interesting note. They have an equal weight rating. Their target price is close to where the current stock price is, but they are saying that on the back of the recent run-up that you've seen from previous result to this result, because of this result just being in line to a slightly weakish EBITDA number, they expect that there could be a marginal correction as far as Asian Paint goes.
Okay, let's also go across to Vivek on the MSCI rejig that's up ahead. Vivek?
Well, that's right. So, the one key factor that you need to keep an eye out for would be the changes, would be the inclusion and exclusion as far as the MSCI EM index is concerned. Now, remember, broad-based, what is it that you're looking at as far as the entire EM index? If all of the changes that the Morgan Stanley note have suggested, Morgan Stanley believes that India's weightage as far as the EM index is concerned could raise by almost 37 basis points from the current level of close to 8.89%. So you could see significant inflows coming into India. Also, they believe that as soon as the government's notification as far as raising the FPI cap is concerned, that could trigger some more inflows. Also, if you're talking about the date, the MSCI index review would be held on November 7th. So all changes would be effective from November 7th, and November 8th is when early morning you would actually be getting the changes. So according to the calculations done by Morgan Stanley, the candidates for inclusion as far as the MSCI EM index are concerned, number one, you're looking at SBI Life, ICICI Prudential Life, as well as Siemens India, while what they believe could be likely exclusions from this particular index. Number one is Indiabulls Housing Finance, as well as Glenmark Pharma. Now, very interestingly, also remember this particular note was making its rounds yesterday on the back of the fact that the foreign holding as far as ICICI Bank had reduced this particular quarter. So that actually creates more headroom for FII buying. So Morgan Stanley believes that you could actually see the weightage in FII flows in ICICI Bank actually increasing, which is why they also believe that ICICI Bank should be on the radar.
ICICI Bank should be on the radar. It's crowded. It's on everyone's radar. 300 has become 450. Kunal will say it's momentum. I would say it's crowded.
Kunal, what do you say?
So, yeah, I think the stock still looks fairly good. Yeah, it's riding on high momentum, but those momentum needs a lot of negative news flow, whether it's lack of volumes, whether it's fresh shorts which gets created to try and take a contra trade over here. But I believe that the stock is enjoying a steady upside. It's been backed by very strong delivery data in terms of volumes as well, and that too on a consistent basis. So 3 days of correction, even if it's sharp in nature, but then you see a steady uptrend. That itself indicates that even though you see a bit of interruptions in between, but the path for the upside is still steady for ICICI Bank. So I would continue to believe that the stock can continue to move up higher until unless it sees a complete reversal of trend in the volume patterns, which has not been seen in the last, I think, few months.
Sameer, what do you make of Asian Paints' performance? Pankaj was just highlighting what the street estimates are, what the brokerage reaction has been. But for a fresh investor, can they jump in at this point? Nikunj and I were talking, if you have that 5-10 year horizon, you're not going to lose much. Any time is a good time to get into Asian Paints. But what if you have a time horizon of next 2 to 3 years? Do you buy Asian Paints fresh at these levels?
Well, I think most of these are franchise companies. So, you can buy them at any time. And then if you roll out 3, 5, 10 years, you will continue to make better than market returns. But the challenge is that today, in a slowdown kind of a mindset, a company comes out with and reports very strong decorative paints volume growth numbers. Now, that's a very healthy sign, which is also corroborating the fact that even Levers reported very healthy underlying volume growth. But I think one needs to get a sense whether, and probably that's the reason why they're getting valued as well, because most of them are all 40 times plus in terms of forward earnings basis. So I think because the value is already there, now from here onwards, either the core economy starts picking up, so you see there is a switch of flow rotation, then you see that there is better returns to be made elsewhere. But otherwise, till that time that evidence of pickup on the ground is visible, I think these will continue to be high trades, where more amount of allocations that keep coming in, investors are more likely to stay put here because visibility of earnings is better. Even though the earnings growth may not be 20-25% that is being expected on a revival basis, but at least 10-15% is good enough for people as long as there is visibility. But I think the larger concern is that when you have a staples universe which is quoting at say 40-45 times forward, from here onwards there is no value argument. So for a value investor, I'm sure these stocks don't sort of make the grade.
What should we expect to hear from L&T today?
I think, Nikunj, people would like to know what is the order book growth? Is there any pickup in traction? What is the tendering like? And what is L&T seeing in terms of is there any private sector capex recovery post the tax cuts, etc.? So I think those are important signals, because pace of execution, well, the last quarter has seen some challenges in terms of weather disruptions, etc. So that's okay. But I think the whole thing about private sector capex revival, which should be then translating into order book, that is what investors would look for. And I think with L&T, there's also a case of they have stated that they want to get out of non-core areas. So what is the roadmap and the timelines on that?
Last time the commentary on order book was not bad, but it was not great, because the management explicitly just said one thing, which is that the private sector business has slowed down. International business is not in a disarray, but we are not feeling very excited about it. Will the government do all the heavy lifting? And will there be a renewed vigor which will come from corporate India? If at all, I don't think L&T will mention it today, because whatever recovery we are talking about from corporate spending, that will only come in the second half of this year. And right now, I think it's too early for anyone to assume and speculate that we are in for a private sector revival, which is the point, Aisha, we were making in the morning, that look, whether Asian Paints is expensive or whether Asian Paints is not going to create a lot of wealth, I think that's secondary. The economy is not at a cusp of a recovery. It's not that tomorrow morning you'll get up and you'll see a double rainbow for Indian economy. It's not going to happen. In that moment, when you are in this transition where gradual healing will start, markets will like to buy some of these stocks. And if you are here for 8-10 years, you may not make money for 5 years. Yeah. This example which is given to me by everyone is that HUL 1995 to 2000 didn't do anything. Why should we buy expensive stocks? So you may not make money in the next 3 years. But if you're for 3 years, then don't buy the stock. Very simple.
Okay.
Which is a 44% since budget, since budget, and 83% for this year. But on the other side, you got something like life, general insurance companies like New India Insurance and all, which have really plunged and plummeted to a record low. Then you also have PSU banks, where from a market standpoint, the importance has just got nullified. And with the exception of SBI and to some extent BOB, the numbers have been, returns have been respectable. Rest of the PSU space, banking space, has just got smoked. I guess smoked is the word for some of those stocks. Would you dare to buy a PSU stock? Or you said, look, I'm going to buy it, doesn't matter what the world thinks.
Nikunj, I think PSUs have had, they've been like the classical value trap, so to say. For them, the only problem is that they are great cash machines, available at fantastic yields. The only challenge is that one doesn't know that there is a CPSE ETF overhang, B, can I really say that the management is sort of, can I give it a continuous P? Now, for that extent, one doesn't know because they are so prone to regulatory interference. That's the reason why probably they don't get valued as they should be. But having said that, there are a lot of names and large companies, Coal India, BEL. I think these are names where even today, I think the outlook is definitely bright. The valuations are very comforting, and the government is making the right noises and trying to make a change in these specific sectors. So be it the oil marketing companies, Coal India, BEL, I think these are places where one would be more open to taking a bet even with the overhang of a classical PSU. So to answer your question, I think these are bets that one should definitely take from a 3 to 5 year horizon, because if things have to happen, if government has stated that yes, I need to do the strategic divestment, so I think these are names that you will start seeing a lot of perception changes likely to happen.
Okay, Kunal, a few stocks that are standing out. Piramal, also of course on earnings, now fundraising plans, but the stock's seen some heavy action. Jubilant Food again on earnings, but again very active yesterday. L&T Tech, another one. Of these, what's looking attractive at these levels?
I think Jubilant Food is the one which looks fairly attractive because it's not one of the stocks which corrected significantly. I think the correction for Jubilant Food halted very close to the 200 DMA. You saw the volumes in the correction also, which was slightly lower than what it was when the stock picked up pace yet again. I think from 1100 levels, if I'm not wrong, the stock has now come back to 1400 plus. So it's a sizable recovery for Jubilant Food in the last 1.5 or 2 months, and now on the back of such strong volumes and price patterns, I think this stock should be due for a breakout. I think the previous high in the month of September for Jubilant Food was around 1520. So the stock should try and claw back to those 1500 levels maybe over the next 1 to 2 weeks.
CK, I have to go back to PSU stocks because the sense I'm getting from old timers, from some of the stalwarts, is that sometimes bad businesses at a good price, they make up for attractive investments. Which is the strongest PSU stock? And it's a wide spectrum, CK. Don't restrict I'll request you not to restrict yourself to 1 or 2 sectors, but across the board within the PSU space, name the strongest and the weakest name for us.
Well, I think if you're looking at the strongest name, then it would definitely have to be BPCL. Now, you yourself enumerated the kind of returns that BPCL has shown. So very clearly, the market's preference is for BPCL at the moment, and the charts also describe a similar situation as far as the momentum aspect as well as the consistency in the trend pattern is concerned. Now, if you were to look for weak pockets, but where we can still try and prospect for some buys, I think market has taken a rather severe view on what perhaps the government is forcing State Bank to do, and that is why that stock has got beaten down so severely. It was actually coasting along pretty comfortably, and since we are near Diwali season, I recall distinctly that last Diwali when we all spoke, I think there was near unanimity that State Bank would be one of the top stocks to perform. It did perform reasonably well, but I think got hit down during the last couple of months. So I think State Bank has pulled back very well to a significantly more attractive area. I think there'll be some short-term considerations which might keep it under, but I would believe strongest in terms of chart patterns would be BPCL, and the most valuable in terms of chart patterns for a revival from here could be State Bank of India.
All right. State Bank of India, let's get your view as well, Sameer, because we've been talking about that quite a bit, and whether or not, if we go by the deep cyclical theory, and we might actually start to see, as CK also pointed out, a revival in some of these names, a proper opportunity. What do you think?
I think our SBI has definitely given enough to investors to suggest that they are the worst of asset quality is behind us. But having said that, I think what has happened starting this financial year is the first quarter we saw banks taking back a lot of share from the NBFC in the lending market, and hopefully the trend should sustain even in the second quarter. But the problem is that today demand for credit is actually so low that despite this, even SBI is not looking at loan growth of more than 12-13%. So I think the challenge is that the moment credit cycle revival is what will probably lead to a lot of confidence coming back. In terms of valuations being comfortable, yes. In terms of their subsidiary value now getting completely discovered, of course, that is also a very comforting point. And the fact that the worst of the asset cycle is behind us. Of course, if IBC implementation could have been speeded up, things would have been even better. The confidence would have been higher. But I think the valuation is giving a lot of comfort, more so because today you see the disparity of a private financial available at 2.5, 3 times book, and now seeing a lot of asset quality concerns coming up, whereas a PSU available at book and with the worst of the asset quality pressure behind them. So I think that's where the trade-off seems to be coming to now.
I want to mark the Bank Nifty for a second here, and right from the corporate tax cut, what's happened to the Bank Nifty. And why am I marking the Bank Nifty, or I'll request Konika to mark the Bank Nifty here versus the Nifty, is because post the corporate tax cut, the Bank Nifty gained some traction and then it saw a lot of volatility. But so the Bank Nifty, what it has done from 19th of September, it is up 4.5%. That's it. That's it. What has Nifty done during that same time? Let's look at that same graph. Nifty during the same time, now we're changing dates here, I think. Nifty during the same time has given you a flat return, almost a flat return of 22 points. So the Bank Nifty has started outperforming the Nifty. That's point number one. 85% of the Bank Nifty is a function of ICICI Bank, HDFC Bank, Kotak Mahindra Bank and Axis Bank. 3 numbers are out. The 4th one is ICICI Bank. And if the commentary is anything to go by, we are not in for a disaster from ICICI Bank, which means the heart of the market, which is the Bank Nifty, from an earnings standpoint, markets have already reacted to it. And in terms of the suspense factor as to where the Bank Nifty would move and where markets would move, in the short term, I think that move is clearly over.